Hi there. So, this is a video for you financial advisors out there. I've had a number of financial advisors approach me, and when I go through the initial assessment process with them, a big thing I'm looking at is the quality of their record keeping because, as a tax professional, the work that I do ultimately rests on the shoulders of good record keeping. And something I've noticed in my conversations with several financial advisors is that I don't think they understand some of the core mechanics of how a financial statement works or how an accounting system works, which is totally fine because there's a reason why, you have to get like a 4-year degree in this kind of stuff. But I wanted to just do a basic video overview of what what financial statements are about so that when you're dealing with tax professionals or other accountants, you don't have to feel like you don't know what's going on or that you're just like randomly exporting stuff out of QuickBooks and it's meaningless for you. So I'm just going to start with some of the basics, and I'm just going to assume that you don't really know anything about accounting. That you might be one of those people that think that accounting and counting are the same thing, and they're not. Basically, in accounting, the overarching thing that we're looking at is that we are working in a system when you're in a business. So if you're used to doing financial advising for individuals, they don't have, most of them, unless it's like a family office setup, like they don't have financial statements, like they don't use a formal accounting. It is just kind of like counting. But for you in a business and the way that the IRS wants you to keep your records, especially if you have significant activity going on, is that you really need to have a formal accounting system. And the system that we use it's called a double entry system, which means that you basically have, whenever a transaction happens, unlike with counting where you would just total up transactions, with this, you have a system where an entry will go on one place and then it will go on the other. And so if you took an accounting course in college, you'd be familiar with the old debit and credit. And so basically, whenever you have a transaction, you're going to have a debit side and a credit side. And that core little piece right there is the reason why we look at two financial statements primarily when we're going to do tax returns. The first one is the profit and loss, which is a P, not an R. So we look at the profit and loss. And then the second one that we look at is the balance sheet, because fundamentally, these two financial statements are reflecting this kind of core component of the two pieces of every transaction that happens. And then the third thing that very often tax advisors will ask for if they don't have direct access into your QuickBooks account is going to be a general ledger. And the general ledger is basically just all transactions. And how this works is whenever you have a transaction, so if you're in QuickBooks, this is the underlying like brain of what's going on in a QuickBooks account. It's basically just this fundamental system of you have these transactions, one side's got a debit, the other side's got a credit, and they live in accounts. So you have, most businesses have a cash account, you'll have a revenue account, you'll have various expense accounts, you might have a loan account. You got all these little accounts, which is your chart of accounts in QuickBooks. And really what the brain of the system is that you have this general ledger where you say, okay, I made 5 grand. Client paid me 5 grand. It's revenue to me. I earned it in the business. So my cash has a transaction for 5 grand. And then my revenue, because that's where it came from, gets 5 grand too. And you'll notice that with these transactions, you have a debit and a credit. And so the cash goes up 5K and the revenue goes up 5K. And there's a balance here. And so this balance ends up getting maintained in the financial statements that we ask for. And, you don't see any of this in QuickBooks because you'll just go to like a check deposit or you'll like match things in a bank statement. But ultimately, this is going to be like a bank account. And then this is going to be a revenue account. Like it's your quarterly brokerage check or whatever it is that the revenue account is. And so even though you don't see the mechanic of it, this is the brain of what's going on. And so when you have these two financial statements, you've got your profit and loss, and then you've got your balance sheet. And your balance sheet's going to have cash. It's going to have other assets like your vehicles, like maybe your building, all that sort of thing. You're going to have, let me move this out a little bit so you can see it better. Yep. There's a reason why accountants don't really do drawing stuff, huh? Oh my gosh. What is up with this? There we go. It was just being funky. So you've got your cash, your assets, you've got liabilities, which are just things like loans, credit cards, stuff like that. Credit cards, and then you've got your equity, which is your prior year profits, which would be your retained earnings. And then you've got your current year profit. And then you've got money that's left. So you've got distributions. And then there's other stuff like you can have paid in capital. There's just all sorts of things that can be in there. But you kind of got these three main categories, which is going to be your assets, your liabilities, and your equity on your balance sheet. And then on your P&L, it's just basically revenue, expenses. And the cool thing is with this, and then you get your profit. The cool thing is with this is that this whole system balances itself because it's based on this debit credit double entry system here. So when your cash went up, your revenue goes up, but your revenue is a credit balance account versus your cash is normally a debit balance account. And so why do you need to know this? Why is this important? So when you're dealing with tax professionals and other accountants, when you're spitting these reports out of QuickBooks or a bookkeeper is spitting these reports out of QuickBooks, because we have this balancing act that's happening here, and then there's also this other balancing act on the balance sheet where your assets, which carry a debit balance, and your liabilities, which are your loans, your credit cards, they carry a credit balance. Typically, that's their native balance. Will always, when you add them together, equal your equity. Because basically, if you have cash in the business, it came from revenue that was generated, which was a profit, or it could have come from a line of credit. But basically, your equity is going to be showing the past performance, the current performance, et cetera, but they're always going to equal each other. And so why does that even matter, like when you're going to do a tax return, or why do you need to know that? Is that when a tax professional is looking at these two financial statements, the process that we go through, or a good tax professional go through, is we go down all of these balance sheet accounts and say, is this cash balance right? Is this asset balance right? What about these loans? What about these liabilities? What about these distributions? What about last year's retained earnings? Is that correct? Because that's a number that kind of comes forward every year. And if we know that everything on here is correct, that all these numbers are accurate, then we know that the profit is right. And so what spawned me making this video is I had an advisor where she didn't have an accounting system. She basically had a counting system where she would give her deductions to her financial advisor, and she had employees stealing from her. When I looked at her tax return, it was, the amount of profit that was being shown on the return didn't make any sense with what was going on with her cash flows. And the reason why is because there was no balance. And that's why it's really important that you do have a full bookkeeping system, and that these things do need to be checked, because what an accountant will do is we look through and make sure that the balance sheet accounts are right, because then once we know that's right, we know on the P&L your profit's right. And why is that important? When your profit's right, it means that the basis for your taxes is going to be right. Because if you're in a pass-through entity, that's how you're going to get taxed, is based on your profits. And so you want to know that this profit number is right for tax purposes. You also just want to know that in general for running your operations, because if you're missing something, or something's hanging out over here in your QuickBooks and it shouldn't be, like very often I will see a P&L that looks about right, but then I go into their balance sheet and they've got crazy accounts receivable. They've got all these undeposited funds. They might have a cash balance that's negative. They have all sorts of weird stuff that's going on their balance sheet. And what that means is that on the flip side, somewhere else in their accounting system, it's either going to be another error within the balance sheet, or more likely it's going to be an error on their profit and loss statement. And so their profit isn't going to be correctly stated. So that's why it's important that you understand that this is how this system works. And so basically what QuickBooks Online has done is it's allowed people to basically interact with this complex system. Like a good accountant doesn't need QuickBooks Online. Like we could build this whole thing out in Excel because this is the fundamental principle of how everything's working. But what QuickBooks allows you to do is just add certain types of transactions and add certain things, and it follows bank feeds and that sort of thing in order to produce the financial statements. But if you don't understand that this is like the overall mechanism that's going on, you can wonder why does my accountant care about the balance sheet? Why do they care about the profit and loss? Because we need to see all of it and look through it in a systematic way to make sure that the profit's right. And then once we know that the profit's right, that gives us the basis for, okay, so you made 400K this year, then we know that's going to be what is going to have to get reflected within the tax returns, and then, you know, all the rest of the stuff that goes on with tax. But if this side's screwy, then the P&L is going to be screwy, and you could end up like my poor advisor that I'm looking at right now, where she got taxed on 690K, and we're looking back at it, and it's like maybe it's going to be 300K. So you can do math. How bad of a tax bill difference is that? Just because there was no system like this. So that's the basics of what you need to know. Now, a couple other just top pieces of advice here is like, okay, I understand I need to get a QuickBooks account. How do you actually vet a good bookkeeper? Because I don't expect you to do this stuff yourself, nor should you, unless you want to be an accountant. It's not your best and highest use. So what should I ask? Because oftentimes what I'll encounter is that bookkeepers they don't actually understand accounting. They just know how to do like inputs on QuickBooks Online, which does not, if you don't understand the underlying mechanism of what's going on, it's really easy to use QuickBooks to produce an inaccurate result. It's like the same thing with tax people who don't understand the basics of how taxes work and they just operate a tax software. It's really easy to produce an incorrect result if you don't actually know how to read the forms or know how basic taxes work, and you just kind of input stuff into a software and expect it to kick out the right answer. So what should you be asking? Number one, what do they do for reconciliations? Number two, how do you review a balance sheet? And just see how they answer. If it doesn't sound anything like what this video sounded like, that's not a good sign. And then number three would be, can you just explain a debit and a credit to me? Because if they don't understand that core concept, they don't understand like any of this other stuff. They're just an operator for a QuickBooks Online account. So you want to make sure that they at least understand that. And then when you're dealing with tax professionals, something that's really important too is that I've encountered tax professionals who don't understand how this stuff works. And if you're a tax professional and you only work in individual returns, which don't have a balance sheet, it's not a big deal. But if you're doing this for business owners, you know, when the IRS is asking, you know, is auditing you, like the first couple of things they're going to ask for is they're going to want to see that general ledger. They're going to see all the transactions. They want to see a profit and loss. And likely they're going to want to see a balance sheet if you're a big enough entity. A lot of people, if you're of a certain size, you have to report a balance sheet to the IRS. So things that I would ask for a tax professional if I was an advisor. One, what reports do you want? Because if they're not asking for these three things, I'd be pretty concerned. You know, the GL or access to the QBO. And then if you have any kind of decent size of organization going on, I would just ask, what do you do with the balance sheet? And if they don't say like, oh, we go down and make sure that the account balances are right, then basically what they're saying is that, okay, we're just assuming that you've given us completely correct records, which if that's the engagement, that's fine. Like if you have audited financial statements, obviously the tax professional doesn't have to go back through and do this piece of it. But for most smaller, you know, for advisors who aren't having audited financial statements, they need to be looking at both sides of it, because you could have things that are incorrect on that balance sheet and then they'll be recording an incorrect profit number. So something I encountered recently on a return I was looking at is somebody had a bookkeeping, somebody doing the bookkeeping, and the actual bookkeeper was a CPA firm. And I looked at what was on their balance sheet, and they had a big balance in deferred revenue that was like, it was a backward balance. And so when I looked at it and then I went and looked at the transactions underneath, I could see, oh, this actually it shouldn't be getting recorded for them because they're a cash basis taxpayer, and this deferred revenue should be getting deferred. And what it was actually doing on the P&L was it wasn't getting it was getting reported as active income for that year. And so once we did the adjustment, it was like a $50,000 adjustment. If I had just taken that profit and loss statement at face value, he would have overpaid. He would have overpaid on that, on the taxes by that. So it's important to make sure that you're looking at this, and that your tax professionals are looking at both. Because if they don't look at both, and you don't have professional accountants preparing your financial statements, and honestly, like I see stuff from like that was from another CPA firm that sent me information that was bad for the tax returns. So you really have to be careful on these. And the reason why it's important is because when you make sure that that balance sheet's right, it's going to make sure that that P&L is right. Now, you could have stuff categorized incorrectly, right? Like you could have something that's in on the revenue side that's actually an expense, but then the wash will always be the same. Like that pure profit number at the bottom will always be the same. And that's the basis for which you're going to get taxed. So for the most part, the IRS isn't, unless there's something really strange in there, the IRS isn't going to give you trouble on that piece. But so I think I think that's the basics of, at a minimum, what you should know about like the system of how accounting works in order to understand better what accountants are talking about and why we ask for certain statements and why they're important and how they work together. Hey there, I just want to thank you for watching that video. So my name is Catherine Tyndall. I'm a CPA. I wanted to give you a little background on what my firm is. So we're a tax firm that works specifically for financial advisors. I've found in dealing with financial advisors, you guys have some unique issues that a lot of tax professionals aren't aware of, between statutory employee status or dealing with the FINRA rules, or just some of the way that your businesses operate and tend to grow. And so the income tax piece often gets really out of control really quickly. So a lot of the content that I produce is based on my experiences in the field working for advisors, the things that I see them missing, the things I see them needing guidance on, and I want to share those insights with you. Now, a lot of people on these YouTube videos will be like, give me a like and a subscribe. We want to boost the channel and do things like that. I'm not actually interested in that because honestly, I'm more interested in meeting you. So I hang out on LinkedIn. If you Google my name on LinkedIn, Catherine Tyndall, CPA, you'll find me. That's where I post a lot of my like checklists and webinars, and just when stuff's happening with the IRS or things are changing, that's where I'm talking. That's where I spend my time. So find me on LinkedIn, send me a DM, or do a follow or whatever. And I'd be happy to meet you and learn a little more about what you're doing in your practice. And if I have any good resources for you for things that you can implement now, I'll find out and send them to you. I monitor all my own messages, so you'll be talking to me. And I'm looking forward to meet you and learn more about what you're doing in your firm. Have an awesome day.